The paper gold market is collapsing right in front of us, and most people have no idea what's about to hit them. While everyone's distracted by headlines and political theater, the largest wealth transfer in modern history is quietly unfolding in the precious metals markets. And if you're not paying attention, you're going to be on the wrong side of it. Let me show you what's really happening behind the scenes, because the signs are everywhere once you know where to look. Central banks just bought over 1,000 tons of gold for the third consecutive year. Think about that for a second. The institutions that print money, that control monetary policy, that have access to every economic indicator you can imagine, they're dumping their own paper currencies to buy physical gold at a pace we haven't seen since the 1970s. They're not doing this because they're bored. They're doing this because they know something the average investor doesn't. And it's not just any central banks. We're talking about China, Russia, India, Turkey, Poland, countries that are actively working to reduce their dependence on the US dollar. They're converting their dollar reserves into hard assets as fast as they can without crashing the system. The World Gold Council reported that central banks purchased 220 tons in just one quarter alone, a 28% increase from the previous quarter. That's not normal buying behavior. That's panic buying disguised as policy. But here's where it gets really interesting. While central banks are hoarding physical metal, the paper markets are showing cracks that should terrify anyone paying attention. The COMEX, the exchange where gold and silver futures are traded, has a problem. A big problem. For every ounce of physical gold in their vaults, there are dozens of paper claims on that same ounce. It's a fractional reserve system, just like banking, except instead of dollars, it's gold. Now, this works fine as long as everyone plays along. As long as most people are happy to trade paper contracts back and forth without ever asking for delivery. But what happens when that changes? What happens when buyers start demanding physical metal instead of paper promises? We're starting to find out. Silver just surged over 114% to hit $64 per ounce, driven by what analysts are calling supply shortages and booming industrial demand. But that's only part of the story. The real story is that physical silver is becoming increasingly difficult to source at anywhere near the paper price. Dealers are reporting premiums of 20%, 30%, even 40% over spot price for physical coins and bars. That spread tells you everything you need to know about the disconnect between paper and physical markets. Gold has blown past $4,300 per ounce, and analysts are now talking about consolidation around $4,000 to $4,100. But here's what they're not telling you. That consolidation is just a polite way of saying the paper market is trying desperately to suppress prices while physical demand is going parabolic. Every time gold dips, physical buyers around the world step in and absorb everything available. The dips are getting bought faster and faster. Let me paint you a picture of what this looks like on the ground. Imagine you're a large institutional buyer, maybe a sovereign wealth fund, maybe a family office managing billions. You decide you want to add gold to your portfolio. Not paper gold, not an ETF, not a futures contract. Physical gold, bars in a vault with your name on them. So you call up your broker and place an order for, let's say, 10 tons. That's about $1.4 billion at current prices. Not an unusual order for an institution of your size. Your broker says, sure, no problem, we'll get that for you. Then they start making calls, and they quickly discover something unsettling. The metal isn't where it's supposed to be. The LBMA, the London Bullion Market Association, shows plenty of gold on their books. The COMEX shows adequate inventory, but when it comes time to actually move physical bars from point A to point B, suddenly there are delays. Logistical issues? Paperwork problems? Would you be willing to take delivery in 3 months instead of 3 weeks? How about 6 months? This is happening right now. Major buyers are experiencing delivery delays that would have been unthinkable 5 years ago. And it's not because there's no gold in the world. It's because the gold that exists is already spoken for, already pledged, already claimed by multiple parties through the magic of paper contracts. Think about what happened in 1971. Nixon closed the gold window because foreign central banks were showing up at the Fed's door asking to exchange their dollars for gold, as they were entitled to do under the Bretton Woods Agreement. The U.S. didn't have enough gold to meet those claims, so rather than admit insolvency, they changed the rules. They said, sorry, no more gold redemptions. The dollar is now backed by nothing but faith. We're watching the same movie play out again, except this time it's not governments demanding gold from the Fed. It's the entire world demanding physical metal from the paper markets. And the paper markets are running out of metal to deliver. Here's where it gets even more interesting. The commercial banks that run the COMEX, the ones who are short massive amounts of gold and silver futures, they're in a bind. They've been selling paper contracts for years, collecting premiums, making money on the spread between paper and physical. It's been a great trade, but it only works if they can keep the price suppressed and keep physical demand manageable. Right now, neither of those things is happening. The price is exploding despite their best efforts, and physical demand is overwhelming their ability to deliver. They're caught in a classic short squeeze, except instead of a stock, it's a commodity that's been money for 5,000 years, and instead of covering their shorts by buying back contracts, they're going to have to deliver actual metal they don't have. What do you think happens when a major bank defaults on a gold delivery? When they're forced to admit they sold contracts for metal that doesn't exist? The entire paper market loses credibility overnight. Every holder of a paper contract suddenly realizes they're holding a claim on metal that may not be there, and they all rush for the exits at once. That's not speculation. That's math. When you have 100 claims on the same ounce of gold, 99 of those claims are going to be worthless when the music stops. The only question is, which 99? Now let's talk about why this matters to you, even if you don't own an ounce of gold or silver. Because when the paper markets collapse, it's not just precious metals investors who get hurt. It's everyone who holds paper assets, stocks, bonds, cash in the bank. All of it is denominated in currencies that are being printed into oblivion while central banks hoard hard assets. The dollar has lost over 98% of its purchasing power since the Federal Reserve was created. That's not a conspiracy theory. That's just math. A dollar today buys what 2 cents bought in 1913, and the pace of debasement is accelerating. The Fed's balance sheet has exploded from under $1 trillion before the financial crisis to over $8 trillion today. That's 8 times more dollars chasing roughly the same amount of goods and services. But here's the thing most people miss. That debasement doesn't happen evenly. The people closest to the money printer get rich. The people furthest away get destroyed. It's called the Cantillon effect, and it's why wealth inequality has exploded over the past few decades. The rich own assets that inflate with the money supply. The poor and middle class own cash and fixed income securities that get debased. Gold and silver are the escape hatch from that system. They're the assets that can't be printed, can't be debased, can't be inflated away. That's why central banks are buying them. That's why billionaires are buying them. That's why anyone who understands monetary history is buying them. And here's something worth considering if you're sitting on a significant retirement account. There are ways to get physical gold into tax-advantaged accounts without triggering penalties or taxes. I put together a free guide on how gold IRAs work, covering the mechanics of rolling over existing retirement funds into physical precious metals. It's in the description if that's relevant to your situation, just something to be aware of as you're thinking about protecting wealth over the long term. But let's get back to the bigger picture, because the implications of this paper market collapse go way beyond individual portfolios. We're watching the end of the petrodollar system play out in real time. For 50 years, the world has needed dollars to buy oil. That created artificial demand for dollars and allowed the U.S. to run massive deficits without consequence. But that system is breaking down. Saudi Arabia is now accepting yuan for oil. Russia is selling energy in rubles. The BRICS nations are working on a gold-backed trade currency. Every one of these developments reduces demand for dollars and increases demand for hard assets. And as dollar demand falls, all those trillions of dollars sitting in foreign central banks and sovereign wealth funds are going to come home. They're going to flood into U.S. markets looking for real assets to buy. That's going to create inflation like we haven't seen since the 1970s. Except this time, it's going to be worse, because the debt levels are exponentially higher. The U.S. national debt just crossed $36 trillion. That's trillion with a T. The interest payments alone are now over $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare, and it's growing exponentially because we're borrowing money to pay the interest on money we already borrowed. There's no way out of this through conventional means. You can't tax your way out of $36 trillion in debt. You can't grow your way out when the debt is growing faster than the economy. The only way out is inflation. Print money, debase the currency, and pay back the debt with dollars that are worth less than the dollars you borrowed. That's not a prediction. That's the stated policy of every major central bank in the world. They call it flexible average inflation targeting, or quantitative easing, or whatever euphemism sounds least scary. But it all means the same thing. Print money and hope for the best. And while they're printing, they're buying gold because they know how this story ends. They've seen it play out dozens of times throughout history. Weimar Germany, Zimbabwe, Venezuela, Argentina. Every time a government tries to print its way out of a debt crisis, the currency collapses and hard assets soar. The difference this time is that it's not just one country, it's the entire global financial system. The dollar, the euro, the yen, the pound, they're all being debased simultaneously in a race to the bottom. And there's no alternative fiat currency to flee to. The only alternatives are hard assets, real estate, commodities, and especially precious metals. Now, let's talk about the supply side of this equation because that's where things get really interesting. Gold production has been essentially flat for years. The easy gold has been mined. The remaining deposits are deeper, lower grade, more expensive to extract. Mining companies are struggling to replace reserves. The average grade of gold ore has fallen by over 30% in the past decade. What that means is that even as demand is exploding, supply is constrained. You can't just decide to produce more gold the way you can print more dollars. It takes years to bring a new mine online, and even then, you're only adding a few percent to global supply. Silver is even more constrained. Over 50% of silver production comes as a byproduct of mining other metals, copper, lead, zinc. So silver supply is tied to the economics of those base metals, not to silver demand. And industrial demand for silver is going through the roof. Solar panels, electric vehicles, 5G infrastructure, medical applications, all of them require silver, and lots of it. The Silver Institute estimates that industrial demand alone will consume more silver than is mined this year. That means the only way to meet demand is to draw down above-ground inventories. And those inventories are already at multi-decade lows. The COMEX silver inventories have been declining steadily for months. At current rates of withdrawal, they'll be effectively empty within a year. What happens when the world's primary silver exchange runs out of silver? What happens when industrial users can't source the metal they need for production? Prices go vertical. Not up 20% or 50%. Up multiples. We're talking about a potential move from $60 to $200 or higher because at some point, price becomes irrelevant. If you need silver to manufacture your product and there's no silver available, you'll pay whatever it takes to secure supply. And here's the kicker. Most of that silver is being consumed. It's going into products that will never be recycled. Solar panels have a 25-year lifespan. The silver in them is effectively gone from the market for a quarter century. Electric vehicles are similar. Once that silver is embedded in electronics and batteries, it's not coming back. Gold is different because it's mostly held as a store of value. The gold that was mined 1,000 years ago still exists. It's been melted down and recast countless times, but it's still here. Silver gets used up, and we're using it up faster than we're mining it. This is the setup for the most explosive precious metals market in history. Constrained supply, exploding demand, a collapsing paper market, and central banks buying everything they can get their hands on. Every single factor is pointing in the same direction. But here's what most people don't understand. This isn't going to be a smooth, gradual rise. It's going to be violent. There will be days when gold is up $200, days when silver is up $10, and there will be brutal corrections along the way that shake out weak hands. The volatility is going to be extreme because we're not in a normal market. We're in the end stages of a 50-year monetary experiment that's failing in real time. The smart money isn't trying to time the market. They're accumulating physical metal and holding it for the long term. They understand that the goal isn't to trade in and out for profits. The goal is to preserve wealth through a currency crisis, to be holding real assets when paper assets collapse. Think about what happened in 2008. The financial system nearly collapsed. Banks were failing. The stock market crashed. And gold? Gold went from $800 to $1,900 in 3 years. It was the only major asset class that protected wealth through the crisis. And that was just a banking crisis. What we're facing now is a sovereign debt crisis, a currency crisis, a crisis of confidence in the entire fiat monetary system. The moves in precious metals are going to make 2008 look like a warm-up. We're already seeing gold above $4,300 and silver above $60, and we're still in the early stages. Most investors still don't own any precious metals. Most retirement accounts have zero allocation to gold or silver. When that changes, when the mainstream finally wakes up to what's happening, the rush into physical metal is going to be unlike anything we've ever seen. And here's the thing that should keep you up at night. When that rush happens, you won't be able to get metal at any price. The dealers will be sold out. The mints will be sold out. The premiums will be so high that the spot price becomes meaningless. We saw a taste of this during the pandemic when silver premiums hit $10 over spot. Imagine what happens when it's not just retail investors buying, but institutions, pension funds, sovereign wealth funds, all trying to secure physical metal at the same time. The paper market will be in chaos. Futures contracts will be settled in cash instead of metal. ETFs will suspend redemptions. The entire facade will come crashing down, and everyone will suddenly realize that paper gold and physical gold are not the same thing. One is a claim on metal that may or may not exist. The other is actual metal in your possession. This is why central banks are buying physical gold and storing it in their own vaults. They're not buying GLD shares. They're not buying futures contracts. They're buying bars and taking delivery, because they know that when the system breaks, possession is going to be the only thing that matters. Now let's talk about the geopolitical implications, because this isn't happening in a vacuum. The shift away from the dollar is accelerating. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create an alternative to the dollar-based system. They're talking about a gold-backed trade currency. They're building payment systems that bypass SWIFT. They're signing bilateral trade agreements in local currencies. This is a direct challenge to U.S. financial hegemony. For decades, the U.S. has been able to weaponize the dollar, using sanctions and financial pressure to enforce its foreign policy. But that only works if everyone needs dollars. If the world moves to a multipolar currency system with gold as the neutral reserve asset, the U.S. loses that leverage. And the U.S. is not in a position to compete in a gold-backed system. Official U.S. gold reserves are supposedly around 8,000 tons, but those reserves haven't been audited in decades. There are serious questions about whether all that gold actually exists, or if it's been leased out, swapped, or otherwise encumbered. Meanwhile, China has been accumulating gold for years and likely has far more than they officially report. If the world moves to a gold-backed trade system, the countries with the most gold will have the most influence. That's why central banks are buying. They're positioning for a post-dollar world. And if you're not positioned for that world, you're going to be left behind. The signs are everywhere. Record central bank buying, exploding premiums on physical metal, supply shortages, delivery delays, paper market dysfunction. These aren't isolated incidents. They're all symptoms of the same underlying problem. The paper markets are breaking down, and physical metal is becoming the only thing that matters. And here's the final piece of the puzzle that ties it all together. The derivatives market. There are hundreds of trillions of dollars in derivatives contracts tied to interest rates, currencies, and commodities. These contracts are all based on the assumption that the current system continues to function, that central banks can control interest rates, that currencies remain stable, that paper and physical markets stay connected. But what happens when those assumptions break down? What happens when interest rates spike because bond markets lose confidence? When currencies collapse because printing accelerates? When paper and physical markets completely disconnect? All those derivatives contracts become worthless. The counterparty risk becomes systemic. The entire financial system seizes up. This is the real risk that nobody's talking about. It's not just about gold and silver prices going up. It's about the entire financial system potentially coming unglued. And when that happens, the only assets that will hold value are the ones that exist outside the system. Physical precious metals, real estate, productive assets, things that have intrinsic value regardless of what happens to paper markets. The death of paper isn't just about precious metals. It's about the death of paper claims on everything. Paper stocks, paper bonds, paper currencies, all of it is at risk when the system that supports those paper claims breaks down. And we're watching that breakdown happen in real time in the gold and silver markets. It's the canary in the coal mine for the entire financial system. So what do you do with this information? First, understand that this isn't financial advice. This is analysis of what's happening in the markets based on publicly available data. But if you're concerned about the stability of paper assets, if you're worried about currency debasement, if you want to protect wealth through what's coming, then you need to seriously consider hard assets. Physical precious metals are the most liquid, most portable, most universally recognized hard assets in the world. They've been money for thousands of years, and they'll still be money when today's fiat currencies are footnotes in history books. The question isn't whether to own them. The question is how much to own and how quickly to acquire them before the window closes, because that window is closing. Every day, more people wake up to what's happening. Every day, more capital flows into physical metal. Every day, the supply gets tighter and the premiums get higher. At some point, there won't be any metal available at any price. The dealers will be sold out, the mints will be backed up for months, and you'll be stuck holding paper assets that are evaporating in value. The death of paper is happening right now. The only question is whether you're going to recognize it in time to do something about it. The central banks have already made their choice. The billionaires have already made their choice. The institutions are making their choice right now. What's yours going to be?